This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Returns for the U.S. equity markets the last several years have been considerably higher than the long-term averages. The 15-year annual return for the S&P 500 has been just under 10%. And if we go all the way back to 1956, at the inception of the S&P 500 index, the compound annual growth is more like 7.5%. So we should consider a 10% annual return for stocks to really be pretty good. If we look at the last 3 years, however, the S&P 500 has produced nearly 20% annually. To be exact, the 3-year performance is 19.75%. For investment gains, the stock market has been the place to be. Since 2018, every time the market has taken a pause or declined even a little, the best thing an investor could do was to buy the dip. Obviously, as long as the market ultimately moves higher, the strategy works, and over time, the market does move higher. The U.S. economy is growing, and the companies listed in the index grow with it. Higher revenue and earnings producing justifiably higher stock prices. But there are periods where the market gets ahead of itself, when the expectations for future earnings exceed reality, either due to over-optimism, like 2001, or an unforeseen recession, like 2008. Typically, these periods of below-average returns don't last very long, but that depends on the economy and earnings and just how untethered valuations have gotten from reality. Okay, so, I'll cut to the point. Should we buy the dip this time? Recovering from the pandemic, the economy has reopened. Earnings growth has reaccelerated. Profit margins are high. The consumer is in great shape, and the job market has recovered. But all these positives have already been priced in. These are the reasons the S&P 500 index gained nearly 27% last year. Today we're looking at a more normal economic environment. While it still feels like our lives are disrupted by the pandemic, economically speaking, the recovery is mostly done. Unemployment's back below 4%. The massive stimulus to get through the pandemic is gone. Inflation has accelerated beyond expectations, and growth rates for corporate earnings have normalized. Corporate earnings accelerated 67% in 2021, a year after the shutdowns early in the pandemic. This year and next, earnings are forecast to grow a more normal 9%. Aside from the inflation numbers, none of this is particularly bad news, nor is it unexpected, but it is a return to long-term trends. 2022's had a tough start for stocks. Here's the performance of the major indexes this year through February 11th. The NASDAQ, which has a concentration of technology and high-growth companies, has fared the worst, down nearly 12%. Both stocks and bonds are down largely, in both instances, due to rising interest rates. Only the foreign emerging markets are in positive territory due to their dependence on energy exports and are benefiting from the high price of oil. Looking at the performance of the major sectors of the S&P 500, you see the outperformance of energy relative to the rest of the market, again due to high energy prices. Energy was the single worst performing sector early in the pandemic in 2020. Everything else is down this year, with the exception of financial services, which stands to gain in earnings power from rising interest rates. Interest rates are rising, the surprise of stronger than anticipated inflation, partly due to supply chain disruptions, partly due to a tight labor market, partly due to the massive stimulus worldwide through the pandemic, will force the Federal Reserve to hike rates this year. We expect the Fed funds rate to go from 0 currently to 1.25 by the end of the year. Here's a chart of the 10-year Treasury note, which hit 2% for the first time since the beginning of the pandemic. It's worth pointing out that 2% is not a particularly high rate. Interest rates moving up towards historical levels by itself is not a problem. The concern on Wall Street is that the Federal Reserve, in its need to rein in inflation, will overshoot, take rates too high too fast, slow growth too much, and possibly even push the economy into recession. Certainly the possibility of this scenario has increased. However, we think the likelihood is low given the strength of the economy. The last chart I want to show you is expected corporate earnings. The bright yellow bars for the last 3 years are forecasted expectations for the S&P 500. You can see the obvious dip in earnings in 2020 and the dramatic reacceleration in 2021. In 2022 and 23, earnings are still expected to grow nicely, but at a more average rate of 9%. Only 9%? It sounds maybe terrible. It's not. If we hit these forecasts in 2022 and 23, the S&P 500 will be higher than where we are today. If you could be 100% certain of these earnings forecasts, you should buy the dip. Unfortunately, the forecasts are not certain. Will rising interest rates slow the economy too much? It's possible, even if unlikely right now. Will Russia invade Ukraine and create geopolitical havoc worldwide, and how will that affect earnings? That's an even tougher question to answer. Earnings matter to stock valuations, particularly as economic growth normalizes in the post-pandemic economy. If you have any doubt, take a look at the recent stock price movement after some of the recent earnings results. Meta, down 34% through February 11th with its questions about slowing usage and earnings growth, or Netflix, down 35% with slowing subscriber growth and high costs lowering long-term earnings expectations. Compare those with Google or Apple or Microsoft. Yes, they're all down this year as well, but they've held up considerably better with positive December quarter results and a positive earnings outlook. We are buying the dip, but carefully looking for companies with strong earnings growth. Unlike the past few years, many companies will struggle more in 2022. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports in your inbox. Thank you for watching.